What does Dave Ramsey say about the stock market? Does it really return 12% year after year after year? Is it a good decision to put 15% of our income into the stock market? What does Dave himself do with the stock market? How does he invest in it? We're in the process of going through Dave Ramsey's book, The Total Money Makeover. 14 years ago, this was the first book that I read through all the way to learn personal finance. Since then, I've spent 5 or 6 years working full-time as an investor, and I've read a ton of other books. A lot of those books call into question some of Dave Ramsey's claims. So I thought it would be interesting to go back to this book, reread what Dave himself said. The first thing that I like is the focus on simplicity, a simple process for handling our money, and we don't need to overcomplicate it. Dave says, "I often hear about broke finance professors who bemoan that I am way too simple." There's this saying, dumb bulls win over smart bears. Now, what does that mean? So a bull wants to buy stocks, they want to be invested. A bear is saying, no, get rid of them. A lot of times in the media, we hear stories about smart bears who made a great call, market's gonna crash, and they called it beforehand. That movie, The Big Short, it's a fantastic movie. You can learn a lot from watching it. But if you zoom out on that movie and look at the overall picture of it and what it's saying, it is glorifying the smart bears like Michael Burry, a whole bunch of other characters in that story who made money from the 2008 stock market crash. Oftentimes, a smart bear makes a ton of money calling one crash, but they don't get the next one, or they fail to reinvest at the bottom so that they can ride the market back up. That leads into what Dave is saying in this book. He's saying over the long run, the S&P 500, which is the best sort of metric of the overall stock market, has returned 12% per year. It's not saying that every year it goes up 12%. Sometimes it goes up more than that. Sometimes it's a loss. But if you average over all that time, he's saying it's 12%. I don't want to get too much into the statistics, but I just want to share a couple of simpler points about this. So the first point is that for every person investing, there's a defined time when they first invest, when they put the money in, and there's a defined time when they take it out. So a person's actual returns are going to vary quite a bit based on coincidence, more or less. When did they become an adult? Or when did they get an inheritance and put it into the market? When were they ready to retire and to start withdrawing that money from the market? So those two important time frames can have a huge impact on your actual results. We don't experience the average result of all these different people investing, equally over time. We experience our result in our life. And so you have to ask the question, well, if some fraction of people who are investing in the stock market happen to get in at a really bad time or get out at a really bad time, how does that affect the return? The second point I want to discuss is survivorship bias. I invested in a growth and income stock mutual fund many years ago. It has averaged 12% per year since 1934 as of this writing. And then he says the same thing about several other funds. Yet another average returns of 12.01% since 1984, another averaging, and so on and so on. So what's the problem with this kind of logic? The issue is not the long track record of these funds. That is pretty impressive. Averaging 12% over 40, 50, even 80 years is really successful result. But the issue is that when you look at all the mutual funds that are available today, you don't see the ones that died. So if you just pick a fund that's in the market today, of course it has successful returns because it's not dead yet. But that's not the actual situation we face if we're investing in the market. The situation we face is we teleport ourselves back in time to 1934, this first example he gives. And we look at all the funds available in 1934 and we pick one or two or three of those and invest in it. Now, did we pick the winning horse? Did we pick the one that averaged 12% for 80 years? The odds are not very good that we picked the right one. Because in addition to that fund, there were a bunch of others that didn't survive till this year. That one died in 1940. That one died in 1950. That one died in 1976. And so as time goes on and on, more and more of those die off. And yeah, there's still a winner left. But the challenge is not to pick the winner in hindsight. So what about an index fund like the S&P 500? The 500 stocks in there have not been the same all that time. It changes. You know, if one of those goes bankrupt, they leave the S&P 500. And then if another company becomes really successful, they get added to it. So again, with the S&P 500, there's some element of survivorship bias in there. Now, am I saying to stay away from the stock market? Definitely not. You know, I started this discussion by mentioning this saying about dumb bulls winning over smart bears. And in the long run, I think that's true. An attitude of optimism and the willingness to take some risks does win out over being pessimistic, being overly afraid of risk. Next, I want to use this book to answer one of the objections that I think a lot of people have about Dave Ramsey, the objection to just sort of blindly investing in stocks all along the way, 15% per year. He says, I went broke in my late 20s and that experience changed my life. I had already applied the principles of this book to my life for 2.5 decades before the storm hit in 2008, meaning the financial crash in 2008. So when it did hit, I was just a spectator. It didn't hurt me a bit. Actually, I came out ahead by buying real estate at great prices and investing heavily in the stock market while both were down. He was not shoveling all his money into stock market investments. He had set back some cash that he put into the market when it was an opportune time. Now, the statement that it didn't hurt me a bit during the market crash, I'm not sure exactly what he means by that. He might just mean that, yeah, he did lose something from his investments going into the crash, but he was able to buy near the bottom, and therefore when the market bounced back, it didn't hurt him a bit because he actually profited more from that bounce back than he did from the initial loss. That's my guess at what he means, but in any case, it's clear by his own actions and even what he admits in this book, his advice is not to just blindly invest everything, every dollar you get as soon as you get it. So if I had to summarize the approach, it's one that's sort of balanced between dollar cost averaging into the market over time, little by little by little with every month or every paycheck. But at the same time, holding some back so that when the market drops, a potential investor can take advantage of that opportunity. Another thing he says in here that I think makes a lot of sense is that using debt to invest in real estate or the stock market with the hope of a quick return will cause you to go broke the minute the market turns. So that's one of the main points of Dave Ramsey's whole thing, right? It's to avoid debt in any form, whether that's credit cards or margin loans in a stock account, whatever. And we can debate about whether there is a place for debt at all or not. The argument I hear from most people is, well, if I pay my credit card off every month, I get the cash back points from using that card. I never pay any interest. Plus, I delay the payment by a month rather than using a debit card. So Dave Ramsey's wrong. Why not use a credit card? Okay, I'm not going to debate that point. But in this case, where he's talking about using debt in the stock market, I think there's a lot of wisdom there. People get into a lot of trouble when they take out a loan or use some sort of margin in an account in order to juice their returns. If you imagine you can buy 3 times as much dollar value of stocks as you actually have in your account, and then you get 3 times the return, right, if the market goes up. So during good times, it can be tempting for investors or people just playing with the markets to do that, to use that leverage to juice their returns. But what Dave is saying, rightly so, is that as soon as the market turns around, those 3x returns turns into you're losing your money 3 times as fast. And another consequence of that, you can't hold onto the stock through thick and thin no matter what. If you put $100 in your account and buy a $100 stock, then nobody can make you sell that because you own it outright. But imagine instead you put $100 into your account and you buy 3 of those stocks. So now you have 3 shares. The total value of those shares is $300. You got it with a margin loan. Now what happens if the stock price drops? Say it goes down to $65. Suddenly you've lost $35 times 3 shares. So you've lost more than the $100 you initially put in. And now you owe the broker a few dollars. So they're going to automatically sell your 3 shares of stock in order to pay back whoever gave the margin loan, and you're still on the hook for a few dollars. Now there's something else Dave says at the beginning of this book that I want to mention in connection to stocks. He's not actually saying this in that context, but I think it's worth bringing up. He says, I rediscovered God's and Grandma's simple way of handling money. Wealth building isn't rocket science, which is a good thing for me and probably you. Winning at money is 80% behavior and 20% head knowledge. So in general, that's pretty good advice. But when you actually come to the stock market and think about investing and maybe even trading stocks, it's worth realizing that a lot of the people who are on the other side of your trades that you're trading against, they are rocket scientists. They do have like a huge amount of information and knowledge that you don't have. They have computer programs that are trading in the blink of an eye, and you want to make sure you're not competing against them. One of the best ways to do that is to avoid really short time scales, because that's where the algorithms dominate. So in that sense, again, this advice of investing over the long haul, just putting in money year after year, that's probably a much more successful strategy for most people than trying to time the market in and out, day trading, doing really short time frames, stuff like that. So what does the Bible say about the stock market? Well, you can imagine it really doesn't say a whole lot. Sure, there are principles we can take from the Bible, but actually the institution of a stock market was not around in biblical times. Most of their investments were in land, real things that they could see and touch and feel, not like a share of stock that you never actually see. But I think there are principles that do apply. I did another video on Jesus's parable of the rich fool. This is a guy who had a really good crop, stored it up, tore down his barns, built new ones in order to store up that crop. God spoke to him and said, "You fool, your life is going to be taken from you this very day. Who's going to get all that you have stored up?" When we think about investing and storing up for the future, this is a good parable to keep in mind as we do so, to check our hearts and see what's really going on in there. This goes through 4 questions to ask yourself based on this parable as a sort of check to see if your investing is with the right mindset.